But there's a second reason why this has always been nonsense, because there's no evidence that lower interest rates stimulate the economy at any time. Lower rates do not stimulate the economy. Likewise, higher rates do not slow an economy. This idea that the price of money is a key macroeconomic tool, and that lower rates lead to higher growth, higher rates lead to lower growth, is actually one of the central tenets in modern macroeconomics. And it's been repeated so many times that most people think, well, surely that's been tested, proven hundreds of times, thousands of times in all sorts of studies. But no, there is no evidence for this claim whatsoever. If you look at the data, what you find is that you've got interest rates on the vertical axis and nominal GDP growth on the horizontal. There's a positive correlation. So more growth goes hand in hand with higher interest rates. Japanese data, you can use US data, more growth, higher interest rates. Look at the leads and lags. Which one comes first? The official story is rates happen first, they move the economy. The economy follows on the action of the rates. Well, the empirical evidence shows the statistical causation, the timing, is the other way around. So look at Japan. The pink line here is nominal GDP. It started to rise significantly in 87. It took 2 years for interest rates to rise. Then GDP fell, and interest rates follow. This is true also for the US. This is now bond yields. Even the most liquid securities market in the world, the US Treasury market, shows that it follows the economy. Interest rates follow the economy. So first, GDP decelerates, growth falls. Then, with a big time lag, almost a year, interest rates fall. GDP rises, then interest rates rise, then GDP decelerates again, then interest rates fall. So the official story that high rates lead to low growth and low rates lead to high growth is contradicted by reality. It's the other way around in 2 dimensions. High growth leads to high rates, low growth leads to low interest rates. That, of course, raises the question, well, if rates are not what's driving the economy, what is it? Well, you know the answer to that. It's not the price of money, it's the quantity of money. And what is money? It's bank credit. That's what's driving the economy. Bank credit for GDP transactions, and you can show this statistically very clearly, drives nominal GDP. So why do central bankers keep repeating the mantra that they use interest rates as policy tool? It cannot possibly be a policy tool because it follows the economy. Next time they lower rates, it's because they've ensured through their credit policies that the economy is going down, and rates follow that. That's all. Essentially, interest rates are to distract you and to confuse people and hide the truth of how the economy operates and what central banks are doing. Because with interest rates, they will always try to argue, look, we're working really hard to create a recovery. The Bank of Japan for over 20 years has tried very hard to get a recovery. Well, it just didn't work. Tough, isn't it? Well, no, they have not tried hard at all. It's been the Bank of Japan that has prolonged the recession, and that's what central banks do.